Double entry bookkeeping, a friendly explanation. Double entry bookkeeping is the backbone of accounting. It's the system that ensures every financial transaction is recorded accurately by balancing two sides, a debit on the left and a credit on the right. The idea is simple. Every transaction affects at least two accounts, and the total amount of debits must always equal the total amount of credits. This keeps your accounts balanced and in line with the accounting equation. Assets equals liabilities plus equity. Key principles of double entry bookkeeping. For every transaction, 1, you'll make at least one debit entry on the left-hand side. 2, you'll also make at least one credit entry on the right-hand side. 3, the total debits and total credits for each transaction will always be equal. Understanding debits and credits. Debit, left side. A debit can represent any of the following: an increase in an asset. For example, buying office furniture increases your assets, so it's recorded as a debit. An increase in an expense. Paying rent or wages increases your expenses, which is a debit. A decrease in a liability. For instance, paying off a loan reduces your liabilities, so it's recorded as a debit. Credit, right side. A credit can represent any of the following: an increase in a liability. If you borrow money, your liabilities increase, and this is recorded as a credit. An increase in income. Making a sale increases your income, which is a credit. A decrease in an asset. When you pay cash, your cash asset decreases, so it's recorded as a credit. Why is double entry bookkeeping important? The double entry system ensures that your financial records are accurate and complete. By recording both the cause and effect of a transaction, it helps to maintain balance in your books, provide a clear trail of financial activities for auditing and reporting, ensure the accounting equation is always accurate. Exam tip: practice and memorize. For your exams and future studies, remember to practice identifying the debit and credit effects for various transactions. This system forms the foundation of everything you'll learn in accounting. The exam focus point reminds you that being confident with these rules is crucial for success in A1 and beyond. The dual effect of a business transaction. The concept of the dual effect is a cornerstone of accounting and is essential to understanding the double entry bookkeeping system. The idea is simple, yet powerful. Every business transaction affects two accounts, keeping the accounting equation balanced at all times. Whenever a transaction occurs, if one side of the equation changes, the other side must change in a way that keeps the balance intact. This is why the double entry system requires recording every transaction in two parts, one as a debit, left side, and the other as a credit, right side. How dual effect works. The dual effect ensures that every financial activity is accurately reflected in the books. Let's take an example to illustrate this. Example: a business pays $50 in cash for goods. When the business buys goods for $50 and pays in cash, what happens to the cash? The cash, an asset, decreases by $50. What happens to the inventory? The value of goods in inventory, also an asset, increases by $50. In this case, 1, cash decreases, credit. 2, inventory increases, debit. The total value of assets remains unchanged, but the composition of the assets has shifted. This shows how one transaction can impact two different accounts. Double entry bookkeeping system. This system is called double entry because it ensures every transaction is recorded twice, once as a debit, left side, and once as a credit, right side. Here's why it works. 1. Every transaction has two sides. Something is gained and something is given up. 2. The total value of debits is always equal to the total value of credits. Key points to remember. 1. Every transaction has a dual effect. It impacts at least two accounts. One is debited and the other is credited. 2. The equation stays balanced. Changes in assets, liabilities, or capital are always equal on both sides. 3. Double entry ensures accuracy. It prevents errors and creates a clear audit trail. By understanding the dual effect, you'll see that accounting is not just about recording numbers, but about maintaining balance in the financial position of a business. All right, let's break this chart down in a simple and friendly way so it's easier to understand. Understanding debits and credits. In accounting, every transaction is recorded in a ledger account, and these accounts have two sides. Debit on the left-hand side, which represents what the business owns or receives. Credit on the right-hand side, which represents what the business owes or gives. The type of account and the nature of the transaction determine which side, debit or credit, is affected. Let's walk through what each means in practical terms. What happens on the debit side? The debit side is all about things the business owns, gains, or spends. Here's when you would use the debit side. 1. An asset increases. For example, if you buy new office furniture, the value of your assets, furniture, increases. This goes on the debit side. 2. A liability or capital decreases. If you pay off an account payable, a liability, the liability decreases, so you would record this as a debit. 3. Income decreases. If you cancel a sale or give a refund, your income decreases, so you would debit the account. 4. An expense increases. For example, if you spend money on advertising, this is an expense, and it would go on the debit side. What happens on the credit side? The credit side is all about what the business owes, gives, or earns. Here's when you would use the credit side. 1. An asset decreases. For example, if you pay cash for something, your cash decreases. This would be recorded on the credit side. 2. A liability or capital increases. If you buy goods on credit, your liabilities increase, so you would record this as a credit. 3. Income increases. When you make a sale, your income increases, so you record this on the credit side. 4. An expense decreases. If you cancel an expense, like reversing a purchase, the expense decreases, so it goes on the credit side. Key takeaway: the debit and credit sides are like a balancing act. For every action, debit, there's an equal and opposite reaction. Credit. That's what keeps your accounts accurate and your financial records balanced. What is a ledger account? A ledger account is essentially a detailed record where all the transactions related to a specific item are tracked. These items can include assets, like cash or machinery, liabilities, like loans or payables, income, like sales, or expenses, like rent or wages. The ledger account keeps a clear record of every transaction, showing how much money is coming in, going out, and what it's for. Each ledger account is split into two sides. The left side, known as the debit side, records increases in assets or expenses and decreases in liabilities, equity, or income. The right side, known as the credit side, records increases in liabilities, equity, or income, and decreases in assets or expenses. Why is it called a T account? If you look at the structure of a ledger account, it resembles the shape of the letter T. The name of the account is written at the top, and the two sides, debit on the left and credit on the right, are positioned below. This simple layout makes it easy to visually separate and organize transactions into debits and credits. How is a cash transaction recorded in a ledger account? Now let's dive into how cash transactions are recorded using the T account format. Remember, the double-entry bookkeeping system ensures that every transaction has two sides, a debit and a credit, and they must balance. This example shows how various transactions are recorded in the ledger accounts using the double-entry bookkeeping method. Transaction A, a cash sale of $2. What happens? The business makes a sale and receives cash immediately. This increases both the cash account and the sales account. 1. Cash account, asset. When the business receives cash, the cash account increases. Assets increase with a debit. 2. Sales account, income. At the same time, the business earns revenue. Income increases with a credit. Recording in ledger accounts: bank general ledger account, cash, debit $2. Sales account, credit $2. Transaction B. Payment of a rent bill of $150. What happens? The business pays rent. This reduces its cash balance and increases its rent expense. 1. Cash account asset. Paying rent decreases the cash account. Assets decrease with a credit. 2. Rent expense account. The rent expense increases because the business incurred the cost. Expenses increase with a debit. Recording in ledger accounts. Bank general ledger account. Cash. Credit $150. Rent account. Debit $150. Transaction C. Buying goods for $100 in cash. What happens? The business purchases inventory using cash. This reduces cash but increases purchases, an expense account. 1. Cash account asset. Cash decreases because it was used to pay for the goods. This is recorded as a credit. 2. Purchases account. The purchases account increases to reflect the cost of the goods. Expenses increase with a debit. Recording in ledger accounts. Bank general ledger account. Cash, credit $100. Purchases account. Debit $100. Transaction D. Buying shelves for $200 in cash. What happens? The business buys shelves, which are considered a non-current asset. Cash decreases, but the shelves account, another asset, increases. 1. Cash account asset. Cash decreases because it was used to pay for the shelves. This is recorded as a credit. 2. Shelves account asset. The shelves account increases to reflect the purchase. Assets increase with a debit. Recording in ledger accounts. Bank general ledger account cash. Credit $200. Shelves account. Debit $200. Summary of the bank general ledger account. After recording all 4 transactions, the cash account would look like this. Bank general ledger account, cash. Debit side, left, $2 for the cash sale. Credit side, right, $150 for rent payment, $100 for the purchase of goods, $200 for the purchase of shelves. Net effective transactions on the cash account. To determine the final balance in the cash account, add all the amounts on the debit side, only $2. Subtract all the amounts on the credit side, $150, $100, and $200. This shows the total reduction in the business's cash balance after these transactions. This detailed explanation should help all students, including beginners, see how each cash transaction is recorded in the ledger and how the debit and credit system works for each account. This solved question shows how to record cash transactions in Ledger T accounts using the double-entry bookkeeping system, where each transaction affects at least 2 accounts. One account is debited, recorded on the left side, and another is credited, recorded on the right side. Let's break down each transaction clearly and in a way that's easy to understand. Transaction A, a cash sale worth $60. The business sells goods and receives $60 in cash. Here's what happens. 1. Cash and asset increases because the business gets $60. This is recorded as a debit in the bank general ledger account. 2. Sales, income, increases because the business earns $60 from selling goods. This is recorded as a credit in the sales account. How it's recorded in the ledgers. Bank general ledger account, debit, $60 from the sales account. Sales account, credit $60 to the bank general ledger account. Transaction B, payment of a rent bill totaling $4,500. The business pays $4,500 for rent. Here's what happens. 1. Cash and asset decreases because the business pays $4,500. This is recorded as a credit in the bank general ledger account. 2. Rent and expense increases because rent is a business expense. This is recorded as a debit in the rent account. How it's recorded in the ledgers. Bank general ledger account. Credit, $4,500 to the rent account. Rent account. Debit, $4,500 from the bank general ledger account. Transaction C. Buying goods for cash at $3,000. The business purchases goods for $3,000 in cash. Here's what happens. 1. Cash, an asset, decreases because the business spends $3,000. This is recorded as a credit in the bank general ledger account. 2. Purchases, an expense, increases because the business acquires goods for resale or use. This is recorded as a debit in the purchases account. How it's recorded in the ledgers: bank general ledger account, credit $3,000 to the purchases account. Purchases account, debit $3,000 from the bank general ledger account. Transaction D. Buying shelves for cash at $6,000. The business buys shelves for $6,000. Here's what happens. 1. Cash, an asset, decreases because $6,000 is paid. This is recorded as a credit in the bank general ledger account. 2. Shelves, an asset, increase because the business now owns new shelves. This is recorded as a debit in the shelves account. How it's recorded in the ledgers: bank general ledger account, credit $6,000 to the shelves account, shelves account, debit $6,000 from the bank general ledger account. Summary of the bank general ledger account. When all 4 transactions are summarized, the bank general ledger account looks like this. 1. Debit side, cash received, $60 from the sale. 2. Credit side, cash paid out, $4,500 for rent, $3,000 for goods purchased, $6,000 for shelves purchased. This shows the cash inflow debit and cash outflow credit, maintaining the balance in the ledger. Recording credit transactions in ledger accounts. When businesses make transactions, not all of them are settled immediately in cash. Some transactions are conducted on credit terms, meaning the payment will be made or received at a later date. These credit transactions require additional accounts in the ledger, such as trade receivables for money owed to the business and trade payables for money the business owes. Let's break this down step by step so everyone can understand. Key points about credit transactions. 1. What are credit terms? When a business sells goods or services but doesn't receive payment immediately, the amount owed by the customer is recorded as trade receivables. Similarly, when a business purchases goods or services on credit, the amount it owes to the supplier is recorded as trade payables. 2. Why not record it directly in the bank account? Since no cash changes hands at the time of the transaction, you cannot immediately record it in the bank general ledger account. Instead, you use trade receivables or trade payables to track the money owed. 3. The double entry principle still applies. Each transaction affects 2 accounts. One account is debited and another is credited to ensure the books remain balanced. 4. When cash is finally paid or received, the credit balance in the trade receivables or trade payables account is cleared by recording the cash payment or receipt in the bank general ledger account. Examples of credit transactions. Let's look at the table in the attachment and explain how different types of credit transactions are recorded in ledger accounts. Example 1. Selling goods on credit. What happens? A business sells goods to a customer on credit, meaning the customer will pay later. For example, if a business sells goods worth $1,000, income, sales increases, so the sales account is credited. Assets, amount owed by the customer, increase, so the trade receivables account is debited. Entry in the ledger accounts. Trade receivables account, debit $1,000. Sales account, credit $1,000. Example 2, receiving cash from a customer. What happens? When the customer pays the money they owe, the amount is removed from the trade receivables account and added to the bank general ledger account. Cash, an asset, increases, so the bank general ledger account is debited. The receivable amount owed by the customer decreases, so the trade receivables account is credited. Entry in the ledger accounts: Bank General Ledger Account, debit $1,000. Trade receivables account, credit $1,000. Example 3, buying goods on credit. What happens? When the business buys goods from a supplier on credit, it records the expense in the purchases account. At the same time, the amount owed to the supplier is recorded in the trade payables account. Expenses, purchases, increase, so the purchases account is debited. Liabilities, money owed to the supplier, increase, so the trade payables account is credited. Entry in the ledger accounts: purchases account, debit $500. Trade payables account, credit $500. Example 4, paying a supplier. What happens? When the business pays the supplier, the liability amount owed in the trade payables account is cleared and the cash is deducted from the Bank General Ledger account. Cash, an asset, decreases, so the Bank General Ledger account is credited. The payable, money owed to the supplier, decreases, so the trade payables account is debited. Entry in the ledger accounts: trade payables account, debit $500. Bank General Ledger account, credit $500. Understanding the net effect. The net result of these transactions is the same as a cash transaction. However, there's an additional time delay between the initial transaction, recorded in receivables or payables, and the final cash settlement, recorded in the bank account. These extra steps provide a clear record of what's owed to the business and what the business owes others. Let's break this question down step by step and explain why each transaction is recorded as a debit and credit. The goal is to ensure you understand how to apply the double entry system to record transactions in the ledger accounts. Transaction A: bought a machine on credit from A, cost $8,000. Explanation: the business now owns the machine, which is a non-current asset. Assets increase with a debit entry, so we debit the machine account. However, the business hasn't paid for the machine yet. It owes the supplier A. This increases the business's liabilities, recorded with a credit entry in the trade payables account A. Entry: debit machine account for $8,000. Credit trade payables account A for $8,000. Transaction B: bought goods on credit from B, cost $500. Explanation: the business purchased goods, which increases the purchases account, an expense account. Expenses increase with a debit entry. Since the goods were bought on credit, the business now owes the supplier B. This increases the trade payables account B, recorded with a credit entry. Entry: debit purchases account for $500. Credit trade payables account for $500. Transaction C: sold goods on credit to C, value $1,200. Explanation: the business sold goods, creating revenue. This increases the sales account, which is recorded with a credit entry. Since the customer, C, hasn't paid yet, they owe the business money. This is an asset, trade receivables account, which increases with a debit entry. Entry: debit trade receivables account, C, for $1,200. Credit sales account for $1,200. Transaction: paid D, a supplier, $300. Explanation: the business paid a supplier, reducing the cash balance. A reduction in assets, cash, is recorded with a credit entry in the Bank General Ledger account. At the same time, the business reduces its liability to the supplier, D. A decrease in liabilities is recorded with a debit entry in the trade payables account, D. Entry: debit trade payables account, D, for $300. Credit Bank General Ledger account for $300. Transaction E: collected $180 from E, a customer. Explanation: the business collected cash, which increases the cash balance. An increase in assets, cash, is recorded with a debit entry in the bank general ledger account. At the same time, the business reduces the amount owed by the customer, E. A decrease in assets, receivables, is recorded with a credit entry in the trade receivables account, E. Entry, debit bank general ledger account for $180. Credit trade receivables account, E, for $180. Transaction F. Paid wages of $4,000. Explanation. Wages are an expense which increases with a debit entry in the wages expense account. The payment reduces the cash balance. A decrease in assets, cash, is recorded with a credit entry in the bank general ledger account. Entry, debit wages expense account for $4,000. Credit bank general ledger account for $4,000. Transaction G, received rent bill of $700 from landlord. Explanation. The business now owes rent to the landlord, increasing the rent expense account, an expense. Expenses increase with a debit entry. At the same time, the amount owed increases the business's trade payables account, G. Liabilities increase with a credit entry. Entry, debit rent expense account for $700. Credit trade payables account for $700. Transaction, paid rent of $700 to landlord. Explanation, the payment reduces the business's liability to the landlord. A decrease in liabilities is recorded with a debit entry in the trade payables account, G. The payment also reduces the cash balance. A decrease in assets, cash, is recorded with a credit entry in the bank general ledger account. Entry, debit trade payables account, G, for $700. Credit bank general ledger account for $700. Transaction I, paid insurance premium of $90. Explanation. Insurance is an expense which increases with a debit entry in the insurance expense account. The payment reduces the cash balance. A decrease in assets, cash, is recorded with a credit entry in the bank general ledger account. Entry, debit insurance expense account for $90. Credit bank general ledger account for $90. Thank you, everyone, for your attention and for staying with us throughout the lesson. If you found this explanation helpful, please support us by liking the video and subscribing to the channel so you don't miss out on future lessons. In our next session, we'll cover the last topic of Chapter 2, which is asset expenditure and expenses charged to profit and loss. It's an important concept, so don't miss it. Take care and see you in the next lesson.